Hey, good morning, everyone. So I guess some people will be straggling in. I'll just, while that's happening, I'll just take some time to introduce myself. And thank you for having me here. My name is Sam Lee. I actually was in Kingston at the Research and Development Center right after I finished my Ph.D. in chemistry a long time ago. And I actually enjoyed that experience of life in Kingston. But then after 3 years, I actually went to the DuPont's head office in Mississauga, switched from research scientist role into business development. And then I saw a lot of other businesses within the DuPont company. And I really felt life science was very interesting. And I had this gut feel that chemicals and materials wasn't where the future was going to be. So I actually quit DuPont and went into joined a biopharmaceutical company. So that totally changed the trajectory of my career. And I went into essentially from chemistry and materials to life sciences. Then I had a government role taking companies on trade missions around the world, which I never really wanted to be in a government role, but it was turned out in retrospect to be a very exciting thing to see so much of what was going on in the world right after the global financial crisis as well. So quite interesting. And through that process, I met a family office that was extremely wealthy based in India. And they actually hired me to do some work for them. That actually led to a role where I went to Princeton in the United States to work for their pharmaceutical company, which is actually a fairly large global one. So I was there for 8 years, and I just came back to Canada 3 months ago, 4 months now, and that's quite the challenge in a closed border, but I am back now and starting to get a sense of where things are. And it's my pleasure to be able to share with you some of the insights that I've had through the time that I've worked in investing as well as venture capital. One of the things I did was run the venture arm or the entrepreneurial growth arm of DuPont, as well as the Indian pharma company worldwide, and then started up a life science startup accelerator in New York City called IndieBio New York. And then after the first cohort, I came back. So that's in a nutshell my background. And I have a presentation here, which I will show up in the slides. And it'll be in 3 parts. So what we'll do is, if you have questions, feel free to, I know people are reluctant to just talk in there, which is totally fine. Just type it into the chat, or between the first and the second part, or the second and the third part, or at the end, we can also ask questions there. The 3 parts will be as follows. I will start by talking about some macroeconomics about what's going on to drive startups around the world. The second will be the perspective of venture capital from what's actually happening and from the perspective of the company. And the third is to actually look at some case studies of various companies in Canada. So let me just go to a slide share now. Okay, there we go. All right, so I hope everyone can see the slides. Yeah, okay, good. I just got to minimize my screen. All right, so let's start with what's going on with globally with the startup community. And in order to see where things are going in the future, I think it's important to show the history of what's going on globally. So if we go back to around year 2000, that's when we had the dot-com boom. There was only really one city that dominated in the startup world, and that's of course Silicon Valley, which is the San Francisco area, or also called the Bay Area. And there wasn't really any global ranking as anyone did formally. There was some rumors about where these other places may be. Everyone wanted to be the next Silicon Valley. And it wasn't until many years later that various people studying what actually makes a startup community self-sustaining started to realize that there are things like anchors, such as a good research university, some anchor companies. Somebody actually said you need 3 large companies with R&D of each worth over $10 billion. So that's a fairly high bar, but that's one that actually has been a criteria. You need investors, you need mentor networks and talent and so on. So there's a large list of criteria, and some firms have started to categorize it. And then the term ecosystem came out to indicate that you really do need an ecosystem like an organic environment to create a self-sustaining a city or area where you could have startups. And back then, it didn't happen until about 2012, where there was an actual global ranking, and most of them were actually Silicon Valley, not surprisingly, is the top. And then the top 5 are still American cities, with the exception of Tel Aviv, Israel. And then there's a range of others that have some of the criteria, but not all of them. And in Canada, there's Toronto and Vancouver and Waterloo. And then just last year, that ranking has increased. There's about 40 rumored cities, and the top tier ones by that I mean self-sustaining, are now maybe 9 or 10. And what's changed is, yes, there's more cities, and also these cities are now much more global. So with those ones that are self-sustaining, we have London and Beijing, Shanghai, perhaps even Stockholm, depending on the criteria. So that's the direction as to what's going on globally. And these are, as I indicate on the slide, driven by policy, meaning that this is not actually just an initiative of companies themselves. It's governments are doing this by setting up things there. There are civic-minded people. The anchor companies themselves, universities are making efforts to create these ecosystems, and that's what's driving it. However, what's happening here is that what's on the ground is there really are not as many startup companies as one would think when we hear it in the news and talk about these so-called ecosystems. The actual number of companies is actually declining. So here's some data from the United States, where most of the data are available. And in fact, since 1978, there has been a 44% decline in the number of companies that have been formed. And this is not just a US phenomenon, it's actually global. So here we have a chart of the red line are the declining global numbers of startups in the US. There was a little peak in 2014. The yellow one is Western Europe. But worldwide, it's the same thing happening. We have this shown by this blue line. And it is what it is. I'm not a sociologist or economist to explain why. People have written about this, and some speculate that perhaps it's the demographics, perhaps the millennial generation is more risk averse. Perhaps it's just the demographics and timing that people are coming out into an economy where good jobs are available, or that the startups that happened before were because the economy was not so great, and that encouraged more entrepreneurship. Some other people have said that perhaps it's actually the existing companies. When you have such behemoths like Google and Apple and Facebook and so on, they actually stifle competition of startups. And then finally, which is what I think, is that there's just not a lot of initiative on the part of investors themselves, which is the thesis and what I will get into for the rest of this presentation, as well as there's just not a lot of great ideas, despite all the effort being put into creating startup ecosystems. And hopefully, as these ecosystems get better and evolve over time, those ideas will get better. So that's the state of the global startup system. And sometimes people think, yeah, maybe it's because there's not a lot of money out there. There's not enough money, which is usually the case if you're a company and you're trying to find money. But in fact, that's not true. Global liquidity has actually been increasing for a long time now. Liquidity meaning amount of money available to buy things or to invest. Now, this is a very macro scale, what's going on worldwide. And just let's look at the red line, which is global liquidity supply. It's just been going up steadily over time. Then we had the 2008 global financial crisis, and that actually seized things up. So central banks all around the world started to inject even more liquidity in there, and the graph just keeps bumping up. And note that this is a log scale. So if this was a linear scale, it would just zoom off the chart. And then of course we have the pandemic, and banks from their lesson from 2008 have injected even more money into it. So there's actually a lot of money out there. Question is, how does this get down to people like you and me if we're looking to start a company? And so that's where we should look at interest rates, because how the most powerful tool central banks have is through the selection of the interest rate, among other things. And here's the benchmark US 10-year Treasury rate. The US is the currency, it's the reserve currency of the world, so it's important. And apart from that big peak that was stimulated because of the OPEC oil crisis and hyperinflation in the 1970s, it's actually been decreasing steadily. And all worldwide, this has been happening with all countries, including Canada. Canada's just a little bit higher in terms of the interest rate compared to the US and a little more spikier, but the directionality is the same as is shown here. I don't have the Canadian numbers, but this goes back, there's the same graph in the United States going back to the American Revolution. So ignore that spike at post 1776, but it has been going down. United Kingdom going back 300, 400 years. Again, it's going down. Germany, Italy, the continent, this goes back 700 years of data. And since the Industrial Revolution, it's basically been flat, gone up because of the OPEC oil crisis, but it's also been going down. In fact, we are now at an all-time low, totally uncharted territory. And in fact, if we actually look at the real interest rate, they're negative, because you take the interest rate and consider at inflation. You're actually losing money if you have cash. So there's two ways to look at this. The negative is that when I was young, I had a lot of anxiety over information like this. I would just go, oh my God, what's going on? The world's going to end. We've got like an investment bubble, and then everyone's going to lose their job. And over time, I've learned that these kinds of ideas and this kind of anxiety doesn't really play out. The other way to look at it is to be more positive, and that's what we're all here for, is to seize those opportunities, because we are in uncharted territory in an interesting time, which creates opportunities to actually do something new and to make a better world. Now, why is interest rates important? How does this translate to what is important for us? And that is because it affects how investments are made. So here we have, maybe you've heard the 60-40 rule. If investors like you and I, and those could be called retail investors, if we have extra cash, what do we do with it? So the idea, the 60-40 is sort of the starting point, is that you want to have it 60% equities, which is stocks, and 40% in fixed income, which are bonds. And the point of that is to make sure that equities over time will always outperform bonds, but they are extremely volatile, meaning the noise or the up and down of the price is highly variable. You could lose 50% of your investment at one time. So you want to have some fixed income, meaning bonds that are more steady over time, and balance that out. And from there, you can modify your portfolio. You could also have some outside of the box stuff like Bitcoin, but you may not want to have everything in that. You could invest, most people do, in their home. Of course, when you're younger, in your education or at any time is important. But when you start to go to huge institutional investors, we're dealing with a lot more money. These are places that have anywhere from $10 million to $2 trillion to invest. This portfolio starts to change. So you move away from the 60-40 to maybe 100% equities or 100% fixed income or something. But anyway, when you have that, what's going on is that you always want a little bit that's in super high risk or high risk investments, such as venture capital, because you have a little bit, because a lot of that can go to zero. All those investments may not pan out. However, if they're successful, they will give you outsized performance, and that's the purpose of having that. And when we look at this, why are interest rates important is that because right now, when interest rates are zero or negative, that orange part here starts to drag on an investor's portfolio, and you have to think about what to do to rebalance that in times like this. And I won't get into that. That's not what I'm going to talk about. That's the point, is that this is how it actually affects how investments actually get into startups. Now, During the 1990s, I actually wondered, why are there so many venture capital firms in Boston? And the reason for that is because there's a lot of institutional investors based in Boston, pension funds, money managers, mutual funds. And so if you actually have a lot of those, you can have venture capital firms start up and actually start calling on these as customers. So if you're a venture firm and you have like 4 people who want to start one, they'll be called general partners or GPs. You can knock on the doors of all of these institutional investors. So in this example, you may find one fund, some pension fund or something that has 600 million of assets under management. Maybe that fund will have 5% of that allocated to high risk investments, which will be correspond to 30 million. And so maybe you could get some business from them and they will put 5 million in your fund 1. And you continue to do that with other institutional investors in Boston and elsewhere. And you raise your $200 million fund and you're good to go as managing that money to look to invest in startups. Now, if you're successful and you got a good track record, you can go back and do this again and raise fund 2. And you can do this again a few years later and raise fund 3. And that's how that works. Once you have that money as a venture firm, fund 1 is 200 million. Let's look at the economics of this to see how or what's going on. If you have 200 million, about 70 million of that will go into investing in companies. And if you invest in 10 companies, about, let's say half of them will fail. They'll just go to 0. You'll lose all your investment. About 30% of them will break even. These are just averages. And then you'll have 1 or 2 that are left, and 1 will be pretty good, and then 1 is a blockbuster. And it's got to be that 1 and 2, and usually number 1, that makes up for the losses of everything else and have outsized returns ahead of that to actually create an actual win for the fund. And so what you have is, if you've invested 70 million, how you make money as a fund is that you don't use your entire 200. You actually keep 2/3 to continue to invest in that winner, because that's, as it grows, you end up making more money. So the economics and the business model of venture firms is that every investment they choose must have a huge potential. And an interesting trend that is now going on is that as firms try to avoid this model here, when they raise fund 2 and fund 3, what's going on is that number 1 company that's doing really well, they'll just keep investing in it. And that's where you get things like Uber, that they stay private for a long time, continue to grow, and they're pushed to become very outsized global companies. Or you see something like the Japanese SoftBank, where they raise like billions of dollars, and then they start investing billions into companies like Airbnb or WeWork to stimulate that growth. So this is the model, and that's the direction that in which they're going. So that's the end of part 1. I've said a lot, and I just want to recap and see if there's any questions. But the point was to say that the global ecosystem community is growing. However, the companies that are being created are declining, and it's not because of a lack of money. It's because of the way VCs are actually structured and what they do. I'm just going to pause here. I can't see everybody, but are there any questions right now before I go on? Please feel free to just speak up, or I don't see a chat box here, but if someone chats, I think I'll see something pop up. Okay, so let's go on. Now, not all companies are financed by venture capital. If, for example, if you are a dentist and you're starting your dentist's office, you don't really go to a VC to do that. If you have a corner store, you could basically figure out how to do that. You want to open your own chocolate company. Those are not typical investments of venture capital. Venture capital invests in, as I said in the first section, hyper growth, high growth companies. And those are ones that have a very interesting, compelling idea. They need to have a team that's behind it to actually make it happen. And the market has to be real, and you've actually identified and articulated it. And that market is at least $1 billion or more. And this is a typical chart of what the revenues will be over time. And the question is, how do you get there? How do you invest there? So need to, so this is how it happens. I'm going to go backwards here. The public markets are stock exchanges, like the Toronto Stock Exchange. It could be the NASDAQ, New York Stock Exchange. Those have been around for a long time, centuries, and the ways in which money can be raised on those markets are pretty well worked out now. And even now with apps, people like you and me could actually buy stocks in public companies, public meaning they're accessible by the public like us. That's great if you're a very large company and you need to raise a few $100 million or even tens of millions. You could do that on the public markets if you're listed on one of these markets. Venture capital is what is on the private markets that provides financing for companies that are on this hyper growth or this growth stage. And that was an industry that started in the 1940s and through the next 4 decades had its fits and starts and basically gravitated towards Silicon Valley. And things have been pretty well worked out as to the mechanism of how that happens. So if VCs find a company that's a private and a small one to invest in, they would invest around Series A. It's called Series A. And that would let the company reach a certain point in their milestones. And then the VC firm will invest further in a Series B and a C. And just before they go public, it could be a round called a mezzanine round or a Series D. Some go to E and F and so on. It just keeps going. There could be more steps, but eventually the idea is to exit so the money comes back to the investors through an initial public offering, or it's an acquisition by a larger company. So that's the system, and everything has been worked out. There are ways to access financing there. It's not easy, it never is, but at least there's a process. Question is, what's going on at a seed stage? That's not so well defined. Now, that's always been a challenge, and so for companies that have been getting off the ground, for example, from a startup. Oh, what is the blue curve below I9 seed? This curve is just an indication of where your cash flow is. So in the beginning, you're actually going to have to find money somewhere to finance the things that you need to do, whether it's doing some more product development or hiring a team to get various things done, do business development, and so on. And then as your cash flow starts to come positive, that's where it goes above the line. There are some types of industries where that remains cash flow negative for a long time. Biotech is one example of that. There are many companies that are financed with the idea to be hyper growth for a long time, over a long time, but are not cash flow positive. Amazon was like that for a very long time. Uber was like that for a very long time, and so on. But as long as investors see that this cash flow curve or revenue, how much money are you bringing in, starts to scale at some point, that's what compels the investment. So if you're a company that's starting out, where can you find your sources of financing? There are non-dilutive sources, grants. These have been around for a long time. Government programs in the U.S. There's a really popular good one called the Small Business Innovation Research Program. Nowadays, there's pilot programs that certain places may offer for you to test your product. Maybe you find paying customers or corporate partner through your corporate development efforts to help pay for that. But really, if you need investment, it's the co-founders themselves through their own savings. There's rumors of people taking paying for things through credit cards, or you find family and friends and angel investors. These are high net worth individuals, people who probably were successful entrepreneurs earlier in their life and like to go out there and support others like them because that's what they love to do. What's new over the last 15 years is other systems have developed. One of those is because there's so many ecosystems growing, they offer startup awards. These are nominal, but the point is they're non-dilutive, meaning that they don't end up owning your company, any proportion of your company. One could use crowdsourcing. So if you've got paying customers, you could go on Kickstarter and try to raise money through there of a product that you want to launch. And then the most recent but significant development are something called startup accelerators. And through them, because they've been quite successful, they've actually encouraged venture capital to start moving further and earlier stage to do seed stage financing. So let's take a look at what these accelerators are, because there's a difference between what an accelerator and an incubator are. This is from a study done by the Brookings Institution and published in Harvard Business Review a few years ago. So in the US, there have been lots of incubators, but in 2015, there were about only much less accelerators out there. And what's the difference is as follows. If you're a pure play incubator, you know, I actually worked at one point in the Mars building in Toronto. Everybody wondered what the Mars facility was. And it's really, I would say it's an incubator or an innovation center, if they want to call it that, where the business model, where the money comes is charging rent to the tenants. And by that, selection is non-competitive. They're not picking one company versus another company. It's any company that can be at the right stage and qualify for what would be a tenant in their space. And the duration could be for as long as the company stays of a size that's suitable to rent in the center. So there are no cohorts, and mentorship is there. Nowadays there are mentoring programs, but it's mostly co-location of lawyers and financial advisors and so on. The difference with accelerators is that there are cohorts. It's a boot camp for startups, which include intense mentorship, or so they claim, and educational components. And it does culminate after 3 to 6 months, depending on the accelerators program, a demo day where everybody goes up, gives their elevator pitch or a longer pitch. And that may include an investment upon the completion of the program. The first accelerators that started, they do invest, but now that there's so many of them, most of them may not actually have an investment component in the program. And so I just provided this slide to show the history of where these accelerators came from. It was pioneered by Y Combinator, which is the largest accelerator now in the world. The red ones are the 3 largest, Techstars and 500 startups. These there's 170 in the US, a lot more worldwide. CCamp is in the UK. I only listed the earlier ones that actually give you more than $100,000 for your startup. And then there are non-dilutive, meaning that there are some out there that don't actually take equity in your ownership in your company. Village Capital was a very significant one of the first to do this on their own, and then there's a whole bunch others. And this is how significant they are, because by 2015, at least in the US, about 10% of all companies that received a Series A round actually came through one of the top 3 big accelerators. And by 2019, these are the list of anyone who did more than 30 deals a year. These are what are known as very active seed stage investors. Of those, 59% of those deals came actually through an accelerator, and less than half came through investors. But there's a long tail, meaning there's a whole bunch of other investors below investing less than 30 deals a year, and they're massive. So accelerators are not still the big dominant player, but they are significant. So another thing that's happening in the seed stage is how investments actually come about. Very early on, before any of this happened, if someone would say, how would you invest in a company? If your company was worth 100,000 and I as an investor gave you 100,000, well, I'll have, as the investor, 50% of your company. But what if your company's really worth 300,000 and I invest 100,000? I'll have 25% of your company. This is difficult to figure out for a very early stage company. So the equity approach doesn't really work. And what then is what people have been doing is use convertible debt, which means that I'll give you a convertible loan, and we won't figure out what the equity will be until the company reaches a liquidity event, meaning as a price round, or I call this a Series A, when people actually figure out what the actual equity ownership is, and that convertible debt actually converts at a discount of, for example, 25%, and that's the incentive that the investor gets to do that. So when Y Combinator started being a professional seed stage investor, they started doing that, and over time they figured a better way to do it. They call it a simple agreement for future equity as a contract. And that's pretty well used nowadays by many players that do seed stage investing, not just accelerators. And most recently, just a few months ago, there's something that's more investor friendly called a continuous agreement for future equity, so that you're not locked into, for founders, you're not locked into the terms of the investor as tightly. So this area is really emerging. And meanwhile, ecosystems have been also growing. But how do startup companies access other networks, investors, talent? They've gone digital. So in the past, if you wanted to go somewhere, yes, an incubator does serve a good purpose. If you go to a certain ecosystem, you go there and you, through your networking and contacts in real time, you find them. But now many digital platforms have emerged. And one of the things when I was working in an accelerator, one of the things we taught was get onto these platforms so that you can be discovered if you're a startup company or a prospective founder. Now, what this means is that here's the data of how things have changed over time. So of all the companies that reached Series A back in 2009, most of them only raised one round prior to their Series A. And that one round probably came from friends and family or an angel investor, something like that. Just 2 years ago, 2018, most companies have gone through many rounds, maybe 2 or 3 or 4 rounds. That's how things have changed over time. And this may make more hoops for you can interpret this either way. It could mean more hoops that each founder and companies have to go through to raise money, or one could say that it's actually more friendly for founders to just raise the amount of money they need as they grow. So here's the recap. The point of everything I just said was to indicate that there's a lot of mechanisms now that have been developed for seed stage investing, and that may be a good or bad thing. The good thing is it's there. The challenging thing is that now that you've got so many more steps, and as I showed earlier, when you invest in something, every opportunity has to be $1 billion opportunity. It's ever more so for seed stage investors because their investment is tied up longer than VCs investing starting at Series A. So what's that doing is that it's skewing these investors towards super high growth companies. And here the conclusion I come to, I say, is that it will need to bifurcate because this is not sustainable. And over time, these accelerators or other mechanisms will have to find ways to support ventures that are not in these super unicorn, hyper growth or international type companies. Now I'm going to go into some case studies. And before I do that, are there any questions? And again, just please unmute and talk or chat.
Hi, Sam. I have a quick question. I was going to ask, so I've heard some sort of stories or seen from colleagues that have kind of, jumping from accelerator to accelerator and kind of doing a bunch of different ones. And they all have those pros and cons of getting, investment, but then also giving up some equity. Do you have any insight on knowing or any kind of pros and cons to when to join one, and then kind of take a break, or just any kind of thoughts on that? Because I have seen some, sequential. And then are you actually getting time to do the business after that? Just any thoughts?
Right. Yeah, that's a good question because I've seen it myself. And the first time I saw it, I sort of, from an investment perspective, I was wondering. So the answer is, if the accelerator takes equity, the answer is no, because you're going to end up stacking all of these safes or who knows what other structures they end up using. And the cap table becomes so complex, and also the founders themselves will lose so much equity that it will just be unappealing for later investors, and you've reached a dead end. The second explanation is that that's a signaling that you just can't make it to a Series A. So you're just floundering and going from one accelerator to the other, and so you don't really want to telegraph that. The only advantage of doing this is when you go to an under the radar accelerator, perhaps because your local university or something has something, and that sort of gives you your so-called entrepreneurship 101 that lets you do that. Or you go to an accelerator that does not take equity. And the reason they would do this is because you're a node in a network. That's what the accelerator is. It gives you access to potential business development partners or investors. So I won't name any names of accelerators right now, but for example, some are based in a hospital network, for example, and perhaps you need to do pilot studies with some of those hospitals. Some others, their business model does not take equity. They're more like structured as a nonprofit, and they're actually giving you access to investors for those investors' deal flow. When you're at that stage, the question you just ask yourself as founders is that worth your time? Because either way, investors, accelerators are, I'd still call it supposedly an intense boot camp, and there you're deciding what your time will be used for. That's a good question. Any other questions?
Thank you so much for a very good presentation. I wanted to know, like, we talked to a lot of startup entrepreneurs in Canada who are having like really crazy challenges accessing or unlocking financial or funding from either angel investors or capital venture capital firms. And we see many of these companies always go to the US and they end up getting money, and probably they end up even migrating to the US. So in your experience, what do you think maybe we are lacking in the Canadian ecosystem? And what do you think maybe are some of the measures that needs to be taken to address some of these challenges?
Right. So actually, this is a good point, because that's what I'm saying right here, that the future will need to bifurcate. In an earlier slide that I showed, or the first one, in terms of global ecosystems, the top 5 were in the US. And then when you looked at the top 10 just 2 years ago or a year ago, if they're not in the US, it was London or Beijing. And so if you're a company looking for money and you're actually a good company, well, it's a choice of the founder where they want to go, but that is a draw. If otherwise, one will need to bootstrap it, or they may not be successful, and that is a problem. And that's why I think that there needs to be more innovation on the ecosystem side, as well as what accelerators do, or if it's not accelerators, some hybrid or variation of that model. That's for a whole other talk, or that's for policy and what people talk about to figure that out. But the stresses are there. I mean, the title of this talk is the post-COVID world. There's a lot of things happening right now, which are symptoms of systems that are not working well, like difficulties in what I would call, what's the word? Inequality, that you've got some outsized winners and everybody else is not doing so well. And that's just not, people like citizens and their issues. It also is with startup companies, as well as VC firms. Okay, I'm going to keep going on, because there's a few case studies I want to show to illustrate what's going on. And I do have a website, which some of these are described in more detail if you actually want to read about these things. So we'll start with what's going on many years ago. And this is a Canadian entrepreneur, Clemencia Desjardins, from Montreal. And in her case, she started a successful company. She did her Ph.D. at McGill University in the late 80s, early 90s. And her work was to just do something with my window here. Hang on a sec, sorry. She was studying opioid receptors. And back then, the technology to study that was to use radio-labeled peptides, radioiodine, I believe. And those 3 images are actually from her PhD dissertation. That's what those images look like. And her challenge, the unmet need and the difficulty was she was exposing herself to radiation. The experiments were taking a lot of time and they were painstaking. And so her idea, because of a convergence of where technology was going and what the trends were, was instead of using radio labels, why don't we use a fluorescent label? And she was thinking about that halfway into her PhD. She approached the technology transfer office at McGill, and they said to her, oh, you don't have an invention here. So nothing happened. She finished her PhD, and then she went out and looked for angel investors. She was actually offered $2 million as a seed round, and she turned it down because she didn't like or had suspicions about that. So she actually accepted $300,000 instead, and it turned out to be a good investment. She shortly thereafter filed a patent application. She founded her company called Advanced Bioconcept. She actually did a good thing, which was for leadership, hired a person called Lloyd Siegel, Harvard MBA, as well as had business experience to be president in '96. They launched their product shortly thereafter called fluopeptides. There's some pictures of them in some marketing materials on the lower right. And then they got acquired 2 years later. That was really fast by NEN Life Sciences. They left, and NEN in turn got acquired by PerkinElmer for this portfolio of products. And then Clarissa and Lloyd together went on and co-founded Caprion after that. The point here is that this is the solo entrepreneur. The story of being able to do something like this today, probably not so much because of the complexity and where the world's gone. So let's look at where she is version 2. Now she's coming back as the seasoned serial entrepreneur. By then, she's much more networked. She's not only founded Advanced Bioconcept, she's founded Caprion with her business partner earlier. She's been a number of boards. Last she did was a role. She was CEO of a Canadian Center of Excellence in Personalized Medicine. And in that role, around 2012, she read a Nature article that said that there was this drug candidate Roche was testing for emphysema that failed, but the scientists in that paper said it might actually be used and have efficacy in this bone calcifying condition called FOP. So immediately, well, that could be, I don't know what that means, maybe not the next day, she quit and joined Clemencia, which was actually a company she actually had founded, I believe she actually created on paper, getting ready for something for her next gig as CEO. And because of her reputation as a serial founder, she was able to get a seed round pretty quickly from the Business Development Bank of Canada. Negotiating with a top pharma company for rights for their drug is not easy. So she actually got someone to her board who was the CEO of another company in Montreal, and his background was in business development. So he did it for her, and he ended up on the board of Clemencia. His name was Alan. And then very quickly in short order, she just raised a number of rounds, Series A, 2 tranches, meaning that they didn't come all at once. And a mezzanine round went to an IPO to raise more money, all to conduct clinical trials for that drug, ultimately resulting in an acquisition by a pharma company in France called Ipsen. They gave $950 million up front, and then a contingent value right, which means if the drug actually passes clinical trials, they'll get another $350 million. So for investors, for herself, it worked out well. The aftermath, unfortunately, the drug actually had adverse side effects and was pulled off from clinical studies. Now, this is much more complex. And again, this shows just how much experience one needs to actually do something like this. Now, let's look at a third case study, because I mentioned if things start to get complex in certain industries, you'll need a different approach. And venture capital firms are actually starting to do things differently. The traditional model, which is what most firms still do, is they just look for deal flow and decide whether or not to invest. So if you're a young person and an associate wanting to join a venture firm, what gets you in the door is because you bring new deals. You actually know networks and you know how to find startups and founders for them to invest in. But for very complex ones, there are VC firms now that don't do that at all. They create their own companies. They hire entrepreneurs in residence, or they work with very experienced former CEOs and so on to come up with the latest ideas in their field, and then they create the companies themselves. The pioneer of this was the VC arm of Nestle. They sort of dabbled with this in 1999, but the very first one was in Boston called Flagship Ventures, now called Flagship Pioneering. Third Rock Ventures does all drug discovery, and so does Versant. But these are just some examples of companies that are coming out in this space. Let me give you an example of how this happens. I heard about this interesting invention by two professors at the University of Saskatchewan who filed a patent in 2013, endophytic microbial symbionts, basically to make plants more hardier or to make their yields better by putting microbes like either bacterial spores or something into their germinal seeds. And that's really big because this is a more environmentally friendly approach rather than using pesticides or fertilizer, chemical fertilizers. And the patent was filed in February 2013, which means it wasn't even published yet. The tech transfer officer did an interesting thing. He went actually to the US and went to an ag conference and talked about this, and immediately Flagship Pioneering struck a deal with them and closed the deal on the IP deal, on the IP license. And then in the meantime, Flagship Pioneering filed some prophetic patents of their own. Now, I'm not clear whether they just did this on their own. They were doing it already on their own anyway. But within a few months, they filed their own. And whenever you have interesting technology, they never happen in isolation. The Australian Institute of Technology was also working in this area, and Flagship Pioneering went down over there and licensed those patents. And by 2014, they actually incorporated their company called Symbiota and plugged in their 7.5 million Series A. Boom, there you go. So unlike founders who try to raise money, the VC is actually raising their own money for their own company. And they're serious about this because the following year they hire a CEO. And this is a seasoned person who's a Harvard MBA and actually was the founder and CEO of two companies, Chemdex, which was an online chemical supply company and trading company founded during the .com boom, and Anacor Pharmaceuticals, which was acquired by Pfizer for $5 billion. This is a very experienced CEO. And they continue to license other patents from other universities. So in 2016, they had, the point is, if you're a startup company doing this on your own, you won't have the funds to actually create and build out a patent estate. In their case, Symbiota actually accumulated 250 patents. They raised a 100 million Series C, and David Perry was quite prophetic to realize Symbiota is a name farmers will not relate to. They just called it indigo agriculture. And then they really became audacious. They went into seed buying, which is a much more riskier business. It requires more money. And they've continued to raise a lot more funds since then. Now they're going into carbon credit trading. So really, they're calling themselves the Amazon for agriculture. And that's the kind of audacity with which, complete playbook, which I think is amazing. And meanwhile, when I spoke with the tech transfer officer, of course, this was a great deal for them. But just like the question earlier, I was talking about, this is something that went to the States for the business that got built out. Now, let's look at a different way to do this. And this is where I think the future is going. When I was at the Mars building a long time ago, and even today, there's a lot of entrepreneurship 101 courses. You go there and you do it. Now, this fellow is at University of Cambridge. I'm sure there's lots of other people out here in Canada that do these as well. Here on his LinkedIn, there's his webpage. He has his own website. On his LinkedIn profile, he was the co-founder of a startup company. And when you look a little deeper, when you read his what he had to say about what he learned, yes, you could say technically he was a co-founder, but basically it was just a learning project in school. And that's how I think learning in the future will be, is just to learn by doing a project and see if it sticks. In his case, Hypervolt, which was a blockchain startup, didn't stick, but he learned a lot, and as his co-founders, and that's where you get to test something, and if it doesn't work, you come out with skills. You don't call yourself a serial entrepreneur, but you've got real hands-on skills to move forward. Meanwhile, he's also doing something which is not a company at all, but he created a software called Pi Portfolio Op, which is actually used by a lot of investment fund managers, and it's just a project. And this doesn't just happen with students. Here's a seasoned, experienced person out there running companies. Keith Driver, and he was on Bloomberg News recently because he actually secured some financing for his insect protein company in Calgary. There's his background education-wise. He's had senior roles in a lot of different companies, but underlying all of that, because you're in a clean tech space or sustainable space, he's got his own business, really, president of Driver Projects, which is what underlies all of this, is doing things not to create a startup company, but trying to create a project or a product and finding what sticks. Or sometimes because companies themselves, existing large companies, don't have the resources, the time or experience to create something new. If you've created it as a project, that could be sold as an acquisition to a larger company. All right, finally, here is one where I thought of looking at what's going on at Queen's, and I just did a quick patent search. So here's one that just published the 24th of December, a month ago. Very interesting title. I'm a chemist by training, so of course this catches my attention. I wanted to look more, but often the first thing all investors do is to look at who are the inventors. So I scrolled down that patent, and it comes from Professor Gabor Fichtinger's lab, if I pronounce that right. That's one of the inventors and his other student, Mark Asselin. So this is all over the internet, nothing confidential here. This is his GitHub page. This is awesome. I've never seen a GitHub page like this. Totally professional. And this is his mission as he's actually written here. Scroll down a little bit more. Here's his background. Pixel Medical, founder and CEO, Kingston, Ontario, June 2019. So I look up Pixel Medical. Great. So he's not looking for investors. He's just out there to offer his services as a programmer or software developer. And that's one way to do it. Hats off. This is fantastic. Finally, this one. A while ago, there was a book published that they said that if you, by an academic group, they looked at artists at the early stages of their career. They looked at retrospectively. And they could tell what their lifetime earnings are based on where they exhibited their artwork in which galleries. And it was very accurate. They also were able to look at scientists or economists, and based on their publications early in their career, they could determine just how successful they were in the trajectory. And it all has to do with network effects. Who are they working with, or where are they exhibiting their art? And in this case, I was interested in digital twins. Started looking around and saw this interesting article. But then I started to look at the authors. So it always comes back to the people. And this particular person, I wasn't even looking at Queens initially, I think. I don't remember how I did this, but one of the authors is actually an assistant professor at Queens. His co-authors, which I won't get into, are some very interesting people, to say the least. And so this professor at Queens does this kind of work, which is, I think, if this is not my space, but if it was, I would certainly look deeper into this this line of work. So that's a conclusion. The point is, as I said earlier, the world and the way things are working right now is broken. There's a lot of inequality, not just among populations and people, but even in the investing in startup space towards hyper-growth companies, and that's just not sustainable. So what's really important is, and it's also sweeping up in that the top tier global cities are taking this kind of activity and sucking out all of the talent. So there will be a bifurcation is what I think is necessary. It has to happen. I could speculate all I want, but the hyper-growth approach is just not sustainable. And there are things that can happen. I won't get into it because that's a topic for perhaps another time or another session. But that's really the answer to the so-called what's happening in the post-COVID world. It's accelerated some of these issues, and they will play out over the next 2 to 10 years. So I will conclude that there. This was supposed to go from 10 to 11. I can still answer questions. I should say that if you want the slides, you can email me there. There's my website. There's an email there that you can go to as well, and that's it. Thank you very much for your time, and hopefully that's stimulated some thoughts and ideas of what you want to do next. And now I'm open to questions.
Hello, Sam. Bob Jeffries here. I have to go to another meeting. I want to thank you very much. This was absolutely enlightening. I appreciate it immensely.
Yeah, thank you.
Thank you.
Yeah, you're welcome.
Sam, it's Janice. It doesn't seem like we have burning questions, but perhaps they'll be sent to Amanda outside of this meeting, and we can forward them to you, or they may email questions to you directly. I'd certainly like to thank you from Queen's Partnerships and Innovation for preparing this presentation and sharing your insights with us. I think it's been tremendously valuable. And people are asking for you to share your email again. So maybe you can just put that in your chat if you're willing to do so.
Oh, yeah. Yeah, I have my personal email. It's not because I don't want to give it out, or I can do it here. It's just it's a long email. And even when I, let me do that now. People usually spell it wrong and they get my name wrong and everything. Let me see. Whoops. On the Eventbrite, there's another email. It's just easier, cambridge.3@gmail.com. Cambridge Cubed is what I did. I've been using that for years for my subscription newsletters and stuff like that until this Cambridge Analytica scandal blew over in the US. And people are wondering, what is this? Are you a part of that?
Yeah. Well, I know several of us have to jump on to an announcement that the government is giving, which is targeted to Kingston, and Queen's is a partner in. And so I'm going to take my leave now, but do want to thank you again, Sam, and look forward to following up.